let's begin quick revision of the entire unit of accounting standard 3 cash flow statement. This has to be read as two things. One, as chapter 4 unit 1, also as chapter 11 unit 2. Section 2, subsection 40 of Companies Act 2013 talks about financial statements. The word financial statements definition includes balance sheet, statement of profit or loss, statement showing changes in equity, significant accounting policies. Along with that, it will also include the word cash flow statement. So preparation of cash flow statement is part of preparation of your financial statements. And there is an exception which says that certain entities need not do cash flow statement. Which entities need not do cash flow statement? If it is a one-person company, if it is a small company, or if it is a dormant company, it is not under the compulsion of doing cash flow statement. Other than one-person company, small company, and dormant company, you have to prepare cash flow statement. Why do we prepare cash flow statement? Firstly, like we discussed, it's part of financial statements. Nextly, it is a very important financial tool to understand how the company is performing, to understand the financial health of the company. It is a very important tool for decision making of an entity. And talking about the scope, it is prepared along with financial statements for a specific period. It's a period statement, not a position statement. Important definitions in the standard of cash flow statement is: number one, cash. What do you mean by cash? Cash means two things. Number one, cash in hand. Number two, demand deposit with bank. Any demand deposit, money which can be demanded and withdrawn instantly from the bank, is part of cash. Nextly, what is cash equivalent? Cash equivalent is something which is actually not cash, but which can become cash very easily. You need to remember four checkpoints. Firstly, it is an investment which should check how many checkpoints? Four. R, I, S, H, R. Readily convertible. I, insignificant risk. Yes. Short term. H, highly liquid. Readily convertible, insignificant risk, short term, highly liquid investments can be considered as cash equivalent. If you invest in shares, it's not cash equivalent. If you have bought land, building, plant, machinery, furniture, motor vehicle, not cash equivalent. If you bought securities, which are debt instruments of a company which is listed, which are due for redemption within 3 months, it can be considered as cash equivalent. If you have deposit with bank, is it cash equivalent? Depends. If it is demand deposit, it is not cash equivalent, it is cash. If it is time deposit, like your FD, RD, or any other time deposit, it can become cash equivalent provided the time for which you made that investment is 3 months or less. So short means how many months? 3 months, or a period of 90 days. Then we talk about cash flows. Cash flows means cash coming in, cash going out. It is receipt or payment. This receipt or payment is genuinely recorded in our cash book. Cash book will have opening cash, all receipts, all payments, closing cash. This cash book, if we prepare it in a different way, it will become cash flow statement. We divide all the cash inflows, all the cash outflows of our cash book into three activities: operating, investing, financing. What are the three activities? Operating, investing, financing. This gives us better understanding of the organizational structure. When we talk about operating, it is the cash flows that arise from principal activities, principal revenue generation activities of the entity: purchase, sale, payment of regular expenses, payment of overhead. All of these are usually collection from debtors, payment to creditors. All of these are your normal operating activities. But other than operating activities are considered as investing and financing. What are investing? What are financing? The moment you get an idea to do a business, you raise the capital, issue of shares, issue of debentures, raising loan, borrowing money from somebody. All of that is financing activity. Using that, when you buy assets, it becomes investing activity. Finally, when you start business, you buy inventory, you sell inventory, you pay expenses, you pay rent, you pay electricity. All of this will become operating activity. I hope you understood the flow. Using the money that you earned, if you pay income tax, it becomes operating activity. And if the asset is old, you sell the old asset, investing. You buy another new asset, investing. You pay interest on the loan, financing. You repay the debt, financing. You pay dividend to shareholders, financing. Right now it's not there. On that dividend, if you pay dividend distribution tax, financing. Are you people getting this? Very good. This is the flow of activities. This cash flow statement can be prepared under two methods. One, direct method. Second one, indirect. How is direct and indirect method different? Direct and indirect method both give same cash flow. Both are presented almost the same. Only point of difference between direct and indirect method is operating cash flow. What is the only point of difference? Except operating cash flow, investing and financing prepared presented the same way. Operating cash flow prepared differently, but the end answer is same. Under direct method, if operating cash inflow is 1 lakh, under indirect method also operating cash inflow is 1 lakh only. But the way we compute it is different. Are you getting it? What is the right method? As per AS3, read with schedule 3. If you are a company, you have to actually prepare indirect method. But we learn direct method also. If you just want to know the cash flow for a short term, sometimes you can end up doing direct, but as per schedule 3 read with AS3, if an entity has to prepare, you have to mandatorily prepare under which method? Indirect method only. Now, let's start with direct method. Direct method is very easy. Cash book. You take one ninja sword and then cut it into 3 parts. Cash flow statement ready. You cut all operating activities, investing activities, financing activities separate. Operating cash inflow, operating cash outflow. Right, inflow minus outflow, net flow. Operating cash flow done. Take investing cash inflow, investing cash outflow. Right, inflow minus outflow, you get net flow, investing done. Financing inflow, financing outflow. Inflow minus outflow, net flow. That's all. You write operating net flow, investing net flow, financing net flow. Below that, write opening cash and cash equivalent. If you add all of it together, you will get closing cash and cash equivalent. It will match and khatam. It's over. However, under indirect method, investing and financing is same. But how do we compute our operating activities? That's where the interesting discussion starts. We believe that in our financial statements, liability side looks very much like financing activities. Asset side look very much like investing activities. And P&L account, all the items are actually representing operating. So, incomes, whatever are there are inflow, expense, whatever are there are outflow, inflow minus outflow is net cash flow, income minus expense is profit. So, can I say net profit is nothing but cash flow from operating activities? No, I cannot say. But I can say one thing. Net profit as per P&L account is very, very close to be called as cash flow from operating. There are some differences. What are the differences? See, when we write cash flow, we write every rupee received, every rupee paid. But in P&L account, we write 1 rupee which is not received also. If it is accrued income, we write a rupee which is not paid also because it is outstanding expenditure. So we prepare P&L statement on accrual basis. Cash flow statement is nothing but cash basis. So that's one point of difference. The second and only point of difference is in your statement of profit and loss account, you might include some incomes and some expenses which are actually not operating. You might write some incomes and write some expenses which are actually not operating. Some financial income also will be written, financial expense also will be written, investing income also will be written, investing expense also will be written. For example, you end up writing dividend paid, sorry, dividend paid will not be written, interest expense in your statement of profit or loss on finance charges. That is non-operating expenses. Loss on sale of asset will be written in other expenses. Profit on sale of asset will be written in other income. So these are non-operating income recorded in PL, expense as well as income, and non-cash items also will appear. For example, depreciation, for example, expense not paid, for example, income not received will all be included. So if in case we can remove this impact of these non-cash items and non-operating items in P&L, we can transform our net profit as per P&L account to cash flow from operating activities. I'll repeat, is net profit equal to cash flow from operating activities? No, but it is very close. If we can make some changes, we can transform our net profit to what? Cash flow from operating activities. How do we do this? Very simple. We need to remove the impact of two things. What are they? Number one, non-cash items. Number two, non-operating items in our PL. How do we do this? Very simple. If a non-operating or a non-cash item is debited in P&L, what do we do? It is non-operating or non-cash expense debited in P&L. Because of that, profit has gone down. Now you add back. If in case there is non-operating or non-cash income credited in PL, because of that the profit has increased. Now you deduct the same. You get this? So what should we do? We should start with net profit as per P&L. We add back non-cash expense or non-operating expense which is debited to PL. We deduct non-cash income or non-operating income credited to PL. If we do this, we get operating profit before working capital changes. What does that mean? See, we understood that P&L account majorly has only operating items, but not all the items on the liability side of balance sheet is financing. Not all the items on the balance sheet asset side is investing. some items in the balance sheet liability side, some items in the balance sheet asset side actually represent operating items. What are they? Current liabilities and current assets. We need to show the impact of these also in our cash flow for operating activities. How to do? Too irritating to find identity of each transaction and their cash impact. So we have a simple shortcut. If a current liability is increasing, that means we have borrowed money, cash inflow. If a current liability is decreasing, we have repaid that liability, cash decrease. If a current asset is increasing, we have purchased that current asset by paying money. So cash outflow. If a current asset is decreasing, it means we have sold a current asset, cash inflow. I hope you understood. How to remember this? Very easy. For current asset, always do opening minus closing. For current asset, sorry. For current asset, you do opening minus closing. For current liability, you do closing minus opening. Once you do this, you will get operating profit before tax. Are you getting it? From this, what do? You deduct the tax that is paid during the year. Once you pay the tax during the year, you will get the cash flow before extraordinary items. If there is any extraordinary items, add or less. If it is a receipt, you add. If it is a payment, you deduct it. This is the basic understanding. Once we do operating cash flow under indirect method, investing and financing under direct, indirect, both are same. It's absolutely same. This is the overview. By this, you should be knowing everything that's needed. But to ensure that nothing is left out, we'll also revise some important pointers. So I told you to call it cash equivalent. What did I tell you? It should be readily convertible, insignificant risk, short term, and highly liquid. I hope you understood this. Then the next really that you should remember. Okay, with regard to interest paid, it is financing. Whether it is on debentures or bank overdraft or loan or anything, interest paid is financing. Dividend paid is financing. Interest received is investing. Dividend received is, did you understand? Dividend paid, financing. Interest paid, interest received, investing. Dividend received. This is for a trading enterprise or a manufacturing enterprise whose business actually has some product. They're actually manufacturing a product, they're selling a product. Whereas I can become an entity where I don't have a product. Money itself is my product. I borrow money at lower rate of interest. I lend money at higher rate of interest. Such entities are called as financial enterprise or investment enterprise. If your business itself is money, you are a financial enterprise, you are an investing enterprise, then interest paid will not become financing. Interest paid will become operating. Interest received or dividend received will not become investing. It will become operating. But dividend paid will always be financing. Dividend paid will always be financing. We discussed this. Dividend paid is always financing. Dividend received, if it is a financial enterprise, dividend received will become operating. If it is a non-financial enterprise, dividend received will become invested. Did we discuss? Yes. Very good. Then we also saw a question under indirect method. We solved the same question under both direct indirect method. And we understood that under indirect method, to start with, what do we need? Net profit. How do we get net profit? Very simple. Look at statement of profit or loss. If statement of profit or loss is given in the question, take that as a starting point. If statement of profit or loss is not given in the question, what should we do? We have to identify profit. We can either prepare P&L statement, then it will become financial statement chapter plus cash flow. Don't worry, they won't give such a statement. What should you do? You need to use the reserves. Identify the difference between the reserves as the profit earned. You prepare P&L reserve account, general reserve account, CRR account to find the net profit earned during the year as balance sheet figure, which serves as a starting point to determine our cash flow statement under indirect approach. We did a question where we were supposed to determine our net profit using reserve balances. I hope you remember. Sure. Very good. In this point, we understood few things. One, CRR, if it is any created during the year, it is created out of free reserves. That is from security, sorry, that is not from security premium. It will be from general reserve or P&L. It is prepared as per section 69(1) whenever the company has either bought back shares or redeemed preference shares out of own funds. Understood this? Then security premium. Whenever security premium has increased, it means the company has issued the shares. You get it? That's the only way security premium can increase, and there is no other way. And then general reserve, if it increases, it means profit is transferred to general reserve. If general reserve decreases, maybe general reserve is used to create some other reserve, or general reserve is distributed as dividend. That's the possibility. P&L reserve is not P&L account. After P&L account, we prepare P&L reserve. It is appropriation account. It's a reserve. Opening balance credit, closing balance debit. Remember that. And we understood, no, working capital changes, how to compute. For a current asset, you should do opening minus closing. For current liability, you should do closing minus opening. We did a cute problem on this. I hope you remember. Yes, sir. Very good. Whenever we do current assets and current liabilities changes in working capital, current asset you do opening minus closing, current liabilities you do closing minus opening. Don't include three items in changes in working capital. What are they? Number one, provision for tax. Number two, proposed dividend. Number three, cash itself. Number one, provision for tax. Number two, proposed dividend. Number three, cash by itself. Provision for tax. Why? Because provision for tax is not like any other liability. Last year's tax will be paid current year. Current year's tax will be paid next year. If they say opening provision 15, closing provision 10, that does not mean 5,000 tax paid. If opening provision is 15, closing provision is 10. That means opening provision of 15 is the provision created last year, paid during the current year, full 15. Closing provision of 10,000 is the entire provision created during this year. I told you usually ledger account will have one balancing figure. Provision is one beautiful ledger which can have two balancing figures. What did we discuss? We understood that we should open one ledger account for provision for tax. Last year's provision will be paid this year. This year's provision will be paid next year. Logic or the formula is opening provision plus current year provision minus tax paid during the year is closing provision for tax. What is the treatment of provision for tax? Provision created during the year will be debited in P&L account, which has reduced our profit. But this is non-cash expense debited to P&L. Did I tell you this? Whenever provision for tax is debited in P&L account, it is non-cash expense debited in P&L. What should we do with regard to provision for tax? We should add it back in our cash flow computation of operating activities under indirect method. Whatever tax is paid is cash outflow. This should be deducted. We'll do cash flow before tax and then deduct tax paid and we get cash flow after tax. Provision and payment can be same but need not be same. I hope you understood. What to do if there is refund of income tax? Refund of income tax is operating. Refund of income tax is cash inflow. Does it need Does it need any adjustment? Actually, doesn't need any adjustment. But we want to show the cash flow before tax. We want to show the cash flow after tax separately. So already refund of income tax is credited in P&L. Because refund of income tax is already credited in P&L, our net profit has gone up. Net profit is including refund of income tax. So what should we do? Deduct. Deduct it from net profit in cash flow under indirect approach operating activities. When you deduct, we'll get cash flow before tax, then add refund of income tax received because it is operating cash inflow. So first we deduct, then we add. Net impact is 0. But we'd have to still do that. We learned it. Did we? Then we went on to another point where we learned how to deal with our proposed dividend. Before that, extraordinary item. If there is any extraordinary item which is not in the ordinary course, but it is operating in nature, but it is earthquake, loss, insurance claim received, all of these items. This is operating, yes, but ordinary, no. What to do? We need to disclose our cash flow before extraordinary items, cash flow after extraordinary items. So what to do? Let's say it is extraordinary cash inflow, income. It is already credited in PL. Net profit has gone up. So what to do? Deduct it. In the beginning, deduct it. So you'll get cash flow before extraordinary items. Then add that cash inflow. We'll get cash flow including extraordinary items. What if it is extraordinary outflow payment? Then first it is deducted in finding net profit. No. So you add back to net profit. Find cash flow before extraordinary item. Then again deduct it to find cash flow including extraordinary, that is after deduction. Basically net impact is 0. But we want to show before extraordinary. Are you people getting it? Very nice. After this extraordinary item discussion, then we also did discussion on proposed dividend. Proposed dividend, again, it's a current liability, I agree, but don't do closing minus opening in changes in working capital. Why? Because dividend proposed last year is paid this year. Dividend proposed this year is paid next year. I'll repeat. Dividend proposed last year is paid this year. Dividend proposed this year will be paid next year. What to do? Open ledger. Proposed dividend opening credit side, closing debit side. Opening proposed dividend will be paid current year. Closing proposed dividend is declared during current year. So what to do? Whatever dividend is paid is last year's proposed dividend. That payment will be financing outflow. Dividend paid is, and whatever dividend is declared during current year or proposed during current year, it will not be written in P&L account debit side. It will be written in the debit side in P&L reserve, because dividend payment is not charge against income. It is appropriation of income. You all did financial statements. Did you ever write in the expense side? Where would you write? You would write it in reserves and surplus in balance sheet inner column. So with regard to dividend paid, financing outflow, dividend proposed during the year, P&L reserve account debit side you would have to write to find the net profit earned during the year. What did we discuss after this? Last thing, PPE. Whenever a property, plant and equipment is sold during the year, identify the original cost of the asset. From that you deduct the accumulated depreciation on the asset. I'll repeat. Identify the original cost of the asset and deduct the accumulated depreciation from the asset. In this case, 1 lakh is the original cost, 20,000 is the accumulated depreciation. If you deduct, you end up with how much as the WTV? 80,000. Then compare with the selling price. If the selling price is 80 and the original cost minus accumulated depreciation is 80, no profit, no loss. 80,000 cash received will be investing inflow. It will be investing. However, if in case the cash received is 90,000 will become investing inflow. Cash received is 90, asset sold is 80. Cash is 90, asset is 80. Difference 10,000 profit. 10,000 profit will be credited in P&L account. This is non-operating income credited to P&L. So when we do indirect approach to net profit, we should deduct. Why? Already that profit is included, because of which profit has gone up. So now we deduct. You get it? What if it is loss? Meaning assets WDV is 1 lakh minus 20, 80, but selling price is 75. 80,000 is a selling, sorry, 80,000 is a book value. We've sold at 75. We've sold at a lesser price, 5,000 loss. First, you forget loss. 75,000 cash received will be investing inflow. 5,000 loss will be debited in P&L. Because of that, profit has gone down. Under indirect approach, when we do cash flow from operating activities, starting with net profit, add back 5,000. I hope you understood. So, cash received on sale of the asset, investing inflow. Profit on sale of the asset, non-operating income credited to P&L, deducted. Loss on sale of the asset, debited to P&L. Non-operating expense debited to P&L, add back. I hope you understood. This, my friends, is how you revise entire cash flow statement in a quick time. I hope this was helpful and you can progress to do a lot of problems on cash flow statement here.